Last question before we start. You can be on the recording.
I have one more. Are you reading any books? Do you have any books to recommend?
I don't read. I think reading is vastly overrated, to be quite honest. We read too much. We think too little. And that sounds like an extremely strange thing to say. But we read blogs, we read books, we read papers. We spend so much time reading what other people think that we've forgotten how to think on our own. So I'd say read less, think more. Take those 1 hour breaks, walk your dog if you have one, steal somebody else's dog if you don't. And as you go, think about a question, say, how would I answer it? And it's actually a muscle like everything else. The more you work on your own reasoning, the better you'll get at it.
But Professor, I take it an exception to the reading rule is your material, right?
Not necessarily. Even my material, you could probably reason your way to an answer. For this class, you have no choice but to read some of this stuff. But I would say, there's nothing, no rocket science, nothing that I'm going to write that you can't think through on your own. No, it'd be hubris on my part to think that somehow I have this special insight that nobody else does, because I don't. Yeah. Okay, folks, welcome. It's time to begin. The recording has started. The slides are up. So we're going to start with a very quick test on cash flows, because today we're going to leave discount rates behind and start talking about cash flows. And I can't wait, because this is where valuations are made or broken, is in estimating cash flows. Now, one of your tasks is to value a company, right? As of when? May 8th. 2023. Let's be very specific. I want your valuation as of May 8th, a pricing as of May 8th, and a buy or a sell as of May 8th. You're saying, what are you talking about? You'd be surprised, at least about 10% of every class that I teach turn in valuations as of January 1st, 2023. First, if you do give me a valuation as of January 1st, 2023, and you tell me to buy as of January 1st, 2023, what the heck am I supposed to do with that? You can't act on a valuation from a previous point in time because there's nothing I can do about it. If you want to act, your valuations have to be current. Second, do you know why I get that January 1st, 2023 on the valuation? What is it about your valuation that leads you to think, I think, for all the wrong reasons, that your valuation is as of January 1st, 2023? And how many of you have calendar year-end annual reports? Many of you do, right? When you have a calendar year-end annual report, what is the end date for the report? It's December 31st of 2022. So people think if I'm using December 31st of 2022 numbers, I must be valuing the company as of January 1st, 2023. No, you're not. Why not? On January 1st, 2023, would you have had access to Tesla's December 31st, 2022 report? No. In fact, it wasn't until February that report came out. So today, the first question I'm going to ask you is a very simple one. If your job is to come up with an updated valuation, you want all your numbers to be updated, right? Now, some of your numbers are market numbers. They get updated automatically, like what? The T-bond rate. I mean, I hope that you use a T-bond rate that's closer to May 8th, that you're not using a January 1st, 2023 T-bond rate when you value your company. I'm going to update my equity risk premiums at the start of every month. You might not have the time to do the May 1st update, but hopefully at least you'll use the April 1st update of the equity risk premium as your equity risk premium. But you're going to run into a problem with accounting numbers. Some of you might get lucky, which is your accounting numbers will reflect the most recent annual report. And the most recent annual report might be the one that came out, it's the latest report that's come out. But if you try to value your companies today, and some of you should try, I sent you that Excel spreadsheet, and you're looking for updated numbers to use from an accounting perspective, many of you still have 10Ks as of December 31st of 2021. especially outside the US, because people don't update that quickly. Many of you are still working with annual reports that are as of December 31st, 2021. So valuing for the company might say, that's my last annual report. I'm going to use that. So that's your first option. The second is, you might have had a quarterly report come out as of September 30th of 2022, even though you don't have the full year. You could take that last quarter that you got and multiply by 4. As I go through this list, think about what you would do and what you would not do. So take a quarter and report, multiply by 4. The third choice is to add up the last 4 quarters of numbers that you have for your company. It's called a trailing 12-month number. It's easy to do and come up with a trailing 12-month number. The fourth choice is to take, let's say you have the first 3 quarters of 2022 out, but you don't have the last quarter, is to fill in the gap by looking at estimates for the 4th quarter. So here's my question. If you're doing an updated valuation of your company today and your 2022 annual report is not out yet, would you use the 2021 annual report? Would you take the last quarter, which would be the 3rd quarter of 2022, and multiply by 4? Would you take a trailing 12-month number, or create your own 2022 by taking the first 3 quarters of 2022 and the 4th quarter from an estimate? Anybody want to give that a shot? Take the one choice that I shouldn't even be on the table. Which of those 4 choices is a non-starter?
So, Professor, option A should be non-starter?
Option A shouldn't be a non-starter. Why?
We are talking about a report that is almost
it's old, right?
Year old.
I mean, you're valuing a solar tech company. I'll wager the 2021 report is going to be ancient history. And the younger the company, the more you worry about it. So
Yes.
B should be off the table as well.
And what is it about B that should trouble you?
Because quarters are heterogeneous. You have, Christmas sales, holiday sales.
Seasonality, right?
You can't multiply that by 4.
You take a retail company, you take the 3rd quarter and multiply by 4, you're routinely going to underestimate revenues because their biggest quarter is the last quarter of every year, and you're not including it. So option B is off the table. But narrowing it down, right? So you're stuck between trailing 12-month and the last choice. The problem with the last choice is you might be able to get analyst estimates for revenues, maybe even earnings for a company for the 4th quarter, but you're not going to be able to fill in the rest of the details. Can't get CapEx and acquisitions and depreciation and working capital. So it's almost by default, we end up with trailing 12-month numbers. So if today you value a company, the last annual report is still 2021, use trailing 12-month numbers, but leave the door open. For what? Hopefully sometime between now and April, your company's 4th quarter numbers should roll in. Be ready to update your numbers. You're saying, won't that be a lot of work? Not really, just updating numbers and evaluation. Don't wait till April to value a company. Value a company today and update the numbers. It's easy to fix. So today we're going to talk about updating, why it's so critical and why, people get caught up in consistency issues. They're saying, but the annual report is as of December 31st. How come we're using the T-bond rate as of May 9th or May 8th? You're being consistent. You know how you're being consistent? You're using the most updated numbers you can for every single input you can find. It's not your fault that accountants don't update numbers every 2 minutes or every day. Second, today in the context of talking about cash flows, we're going to talk about CapEx. Now, I want you to think back to your accounting class, right? In your accounting class, you ran into CapEx. Or if you're an accountant, you ran into CapEx multiple times over your life. In which financial statement do you usually report CapEx as an accountant? Income statement, balance sheet, statement of cash flows.
Income statement.
Balance
sheet.
It should be the statement of cash flows. You can indirectly maybe get it out of the balance sheet, but it's usually in the statement of cash flows. And I remember what my accounting professor told me about what should go into CapEx. I'll repeat what he said, and then I'll question whether accountants are staying true to their own definition of CapEx. My accounting professor who taught us Accounting 101 said, a CapEx is any expenditure that creates benefits over many years. Let me repeat that again. A CapEx is any expenditure that creates benefits over, as opposed to an operating expense, labor, materials, where it creates revenues this year. So I want you to hold on to that definition. I'm going to list out a bunch of items. And you tell me whether they pass the CapEx test using that broad definition and whether they pass the accounting test and actually show up as CapEx in the statement of cash flows. Building a manufacturing plant.
Yes, and
It
yes.
passes the first test. Does it also show up as CapEx on the statement of cash flows? Yes. So on manufacturing companies, accountants do fine. How about R&D expenses for a technology company? First, is it a CapEx if you define it as an expense over that you expect to get benefits over many years? And
By
no
that
company
definition,
does.
yes.
Yeah, should be.
It might be uncertain. You can argue, I don't know, but so uncertainty is not a dividing line on CapEx versus non-CapEx. R&D is super CapEx. But does it show up as CapEx in the statement of cash flows? It doesn't.
No.
Accountants screw it up big time. So today we're going to talk about R&D and what to do about it. But I'm not done. Let's say you're a consumer product company whose biggest value comes from your brand name, a Coca-Cola. Is some of your advertising to build a brand name? It's not to get you to buy more Coke, it's to build a brand name, right? Is that brand name advertising CapEx, if you define CapEx as benefits over many years?
Yeah.
I think so. But here again, accountants treat all advertising as an expense. What if you're a consulting firm? Think about your biggest asset. It's human capital, right? What you spend on recruiting and training those consultants is your version of CapEx. But guess what accountants do? They expense it. We have a full-fledged accounting inconsistency problem on our hands because accounting, as we know, it was designed for the old-time manufacturing firm, and it's being stretched to the limit and broken as the bulk of the world shifts away from manufacturing. Take a look at the 20 largest market cap companies in the world. I don't think there's a single manufacturing company, not one on that list. Technology firms, pharmaceutical firms, financial service firms. So today I want to come back and talk about what do we do about this accounting inconsistency, because it is screwing up valuations around the world to follow the accounting statements and assume that what you see reported as CapEx is actually the CapEx for a company. So I am going to stop the share and reshare. Let's see. I'm sorry. I'm like doing a dance here. So now we're back on the slides. Let's go back to where we left off. Ah, shoot. Sorry about that. You can see the slides, right? But I can't see the slides. So let me go back, because if I do it on, it's taken over both my displays and I don't like that. Okay, let me share it again. So where we left off, you guys can see the discount rate slide, right? So where we left off last session was talking about the cost of equity. And the cost of equity is a function of the risk-free rate, the beta, and the equity risk premium. It measures what equity investors in your company demand as a return for investing in your equity. But equity is only one way you can raise capital. What's the other? You can go out and borrow money. You can issue bonds. It's debt, right? So today, I want to nail down two questions. One is, what is the cost of debt? And the second is, what should we be including in debt when we do cost of capital? Let's start with the first question. To estimate the cost of debt, I'm going to lay out the ground rules again. What we're trying to estimate is essentially the cost of borrowing long-term today to a company. Let me repeat that again. The cost of debt is the rate at which a company can borrow long-term today. Two keywords there. One is long-term. Why do I throw that in there? It's not true right now, but in most years, when you look at the term structure, short-term rates versus long-term rates, what does the term structure look like in most typical years, in most normal years? Short-term rates are lower than long-term rates or higher? They generally tend to be lower, right? If I measure the cost of debt based on the maturity of the debt you use, as a company, you're going to play games with me. You know how you're going to play games? To make your cost of capital lower, you're going to take on 1-year loans rather than 10-year loans and say, look, my cost of debt is only 2%. And I'm going to say, no, I'm not going to give you that benefit because at the end of the year, you got to roll over that debt into a new 1-year debt. So rather than treat you as having 1-year debt, I'm going to give you a 10-year cost of debt, even though you have 1-year debt. Makes your life a lot simpler because it means you don't have to figure out the tenor or the maturity of the debt the company has. You just have to think about if they were borrowing long-term today, what rate would they pay? The second word was today. I don't care what rate you borrowed at 2 years ago for. Don't even show me your books. Don't show me your existing bank loans. Don't show me your existing bond coupon rates. Because if you're borrowing today, here's how I'm going to compute the cost of debt. Since it's the long-term cost of debt, I'm going to start with the long-term risk-free rate and add to that a default spread. What's a default spread? It's a spread that lenders are going to charge you because of how much they're worried that you might not pay them. You're saying, how the heck am I going to get a default spread? Some companies, there is a service out there or an entity, or there are entities out there that make your life easier, right? Rather than you have to estimate the default risk, they estimate it for you. What am I talking about? You're trying to get a cost of debt for a company. What's an easy fallback if you don't want to make the judgment of how much default risk is there?
Rating companies.
You look at Moody's or S&P or Fitch, they rate your company. Of course, you're taking a risk that they might screw up, but think of how much easier it is to look up the rating, AA, single B, triple B. You're saying, how does that help me? If you can give me a rating for your company, I can tell you what default spread goes with that rating. I can update that rating, and I'll give you ways of doing it. You can get the most updated spreads for your company. So if you have a rating for a company, you can use the default spread based on the rating. In some cases, you'll actually find that your company has bonds outstanding. And you might think that you got an easy way out to get a cost of debt. Because if you have bonds that are traded, you can get the yield to maturity on a bond. That's a current updated interest rate on the bond. And you're going to be tempted to use it as a cost of debt. But before you do that, I want you to think about the answer to a question. Can a risky company issue a safe bond?
Yes, they can.
And what would they need to do to make that bond safe?
Issue more, like higher in the capital structure, more.
In other words, I give you the safest assets, the best cash flows to back up the bonds, and I can borrow at a lower rate than the rate for the company, right? So what I'm trying to say is you can have a company that is risky issue bonds that are safer because they've carved out the safest assets of the company. And your job is to assess a cost of debt for the company, not the bond. This is why Moody's actually and S&P rate companies, but they also rate bonds. Most of the time, the two will converge, but you can actually have a AA rated or a single A rated company issue a AA rated bond on a specific segment of the company. So if you find a bond, don't get too excited. The nice thing about having a bond is there's a rating that goes with it. You can use the rating to come up with the default spread. You say, what if I have a company that doesn't have a rating? For those of you who were in my corporate finance class, I offer a way to get, because remember, 80% of all companies on the face of the earth don't have a rating, especially if you go outside the US, small companies, emerging market companies. You can look up Moody's and S&P, but there's no rating for a company. It's getting better, but you still have a big segment of companies that don't have a rating. So what do I do with these companies? Act like a ratings agency. Give them a rating. It sounds incredibly complicated, but ratings agencies are in many ways the most transparent organizations in the world. You know why? Because they tell you what the rating of every company they rate is. It's public information. They also give away the store. They tell you the 8 ratios they claim to use to come up with the rating. Moody's and S&P used to have that in their front page. These are the 8 ratios. EBITDA to fixed charges, debt to capital. So basically a set of ratios. So about 30 years ago, I said, I want to think like a ratings agency. So I went and downloaded the 8 ratios for every rated company. I downloaded the rating for every rated company. And then I did some reverse engineering. You know what I mean by reverse engineering? I sorted the companies based on ratings. And let me try to figure out why AAA rated companies are AAA rated looking at the ratios. And here's what I found. I found that one of the 8 ratios was carrying the bulk of the load of explaining the ratings. It was the interest coverage ratio. Interest coverage ratio, for those of you who've forgotten your accounting, is just earnings before interest and taxes divided by interest expense. So if you look at Embraer, for instance, I took the earnings before interest and tax, I normalized the numbers because they jumped around. I looked the average, divide by interest expense, I come up with 3.56. What does that tell me? For every dollar of interest expenses, they have $3.56 in operating income available. As a lender, do you want this number to be a high number or a low number? What makes you feel? You want it to be as high as possible, right? You feel safer. I computed, so basically I did basic statistics. What explains the ratings of interest coverage ratio? And I created what's called a lookup table based on how ratings agencies rated companies. Simply put, here's what a lookup table allows you to do. You give me an interest coverage ratio, in the case of Embraer, 3.56. I go look to see where it falls in the lookup table. It's between 3 and 4.25. I assign a rating based on that, A-, and I say, if I were rating your company, I would expect to see an A- rating. I update this lookup table on my website every year. So basically, if you don't have a rating for your company, and this is the nice thing, you have a private company, you can still compute an interest coverage ratio. Go to the table, use the table to, you're saying, why are there 2 columns? One is for larger companies and one is for smaller companies. Life isn't fair. And larger and smaller is based on market cap. It's a $5 billion market cap or higher is larger. It turns out if you're a smaller company, you need a much higher interest coverage ratio to get the same rating. So in this case, with Embraer, the rating that I got for Embraer was A- based on their interest coverage ratio. You're saying, do I have to do this if I have a rating? Not necessarily, but I actually do this just to check my rating to make sure that the ratings agency is not screwed up big time. It's a good idea to actually, this is called a synthetic rating because you're computing the rating on your own. Essentially, you're coming up with a rating based on the interest coverage ratio. So let me complete the story for Embraer. At the time that I did this, I was doing my valuation of Embraer in US dollar terms. It's 2004. The risk-free rate in US dollars, the T-bond rate was 4.29%. Now, based on my rating for Embraer, the rating I gave them was A-, and the default spread is 1%. Now, if this were a US company, I'm done. I take the risk-free rate, I add the default spread, and I walk away, 5.29%. But this is a Brazilian company. You're saying, so what? When you're a company in Brazil and you go to the bank to borrow, you carry 2 burdens on your shoulder. One is your company's default risk, right? And the spread that goes with it. And the other is, and this is the unfair part, is the country's default risk. If you're saying that's so unfair, talk to some Greek companies about how unfair life has been for the last 15 years. You're a Greek company, try to borrow money. You walk into a bank and say, I'm a Greek company. The banker says, that'll be a 15% interest rate, but you haven't even looked at my financials. So here's what I have to do. I have to bring in country risk into my cost of debt. And the way I do this is I take the default spread for Brazil. And most companies, they just add the entire default spread for the country to the cost of debt. Because unlike equity, you can't evade this. Indian companies, even if they get their revenues outside India, often are fully exposed to Indian country risk in terms of cost of debt. But in some cases, like as in Embraer, they have so much exposure outside the domestic market that they're able to be safer than the government. For a long time, Petrobras and Embraer were able to borrow money in dollar terms at a rate lower than the Brazilian government because lenders felt more comfortable lending to them. So here's what I have as my cost of debt. T-bond rate, risk-free rate, plus 1%, that's a company default spread, plus a portion of my country default spread, giving me a dollar cost of debt of 9.29%. That's my pre-tax cost of debt for Embraer in US dollar terms, and I got there using the ratings. Now this table, the lookup table, I'll make a confession. 30 years ago when I did it, it was almost all US companies because only US companies had ratings. Very few European companies were rated. I mean, things have changed. Today, the table can be much richer because you have more companies rated around the world. But I often use this ratings lookup table in countries like Indonesia or India or Brazil, and people say, but can you do that? Is that okay? And I'll give you a qualified answer. It's okay as long as you're looking at risk-free rates that are not wildly different from the dollar risk-free rate. The reason that matters, if you're in a country where the risk-free rate itself is 15%, guess what? You're not going to get interest coverage ratios of 8.5 and higher, because even with a tiny amount of debt, your interest expenses explode. So if you're in a market with very high risk-free rates and working in a currency that has a very high risk-free rate, maybe this table won't work that well. But in most other cases, it travels fairly well. So once you get the rating, you get a default spread, right? That default spread, and I'm stating the obvious here, is not a constant. It changes over time. For instance, take 2022. It was a momentous year, not just for what happened to the T-bond rate, but what happened to default spreads. So what you have in this graph is the default spread on 7 different ratings classes: AAA, AA, single A, triple B, double B, single B, and where it says 0 is triple C and below. So the last column is high yield bonds. So you look at the very first row, that was the spread at the start of the year. So let's take AAA. The default spread at the start of the year was 0.51%. By the time you get to September of 2022, which was the bulk of the movement in 2022, that default spread had widened to 0.65%. It's about a 0.14% increase. If you take a triple B, the default spread started 1.21%. By September, that spread was up to 1.87%. And if you take high yield bonds, 6.78% had become. Notice something, the spreads effect is getting larger with high yield bonds and with that investment grade bonds, and higher with investment grade bonds and with AAA bonds. Last year, if you remember, equity risk premiums exploded out of the box, and you saw that graph. The same thing happened to default spreads. So even if your rating did not change through 2022, your cost of debt changed dramatically, right? Because your risk-free rate went up and your default spread for the same rating went up, which is a kind of a wake-up call of, it don't stay frozen in spreads that are 2, 3, 4 years old. Try to get updated spreads. And I'll give you a couple of sources that I use to get updated spreads that are free. That's a big thing for me, is I look for only free sources. I'm not paying somebody $500 a week or month to update it. I can't pass this on to somebody. So I'll give you a couple of great sites where you can update the spreads. But a point about kind of keeping spreads updated. So in January 2023, this is what the default spreads look like from AAA all the way down to D. So if you give me a rating for your company, or a synthetic or an actual rating, that's a default spread I would use, but I'd keep checking those default spreads to see whether they change during the course of 2023, because who knows what this year will bring. So any questions about ratings and default spreads?
Yeah, Professor, one question. When you consider the table for the synthetic cost of debt, we're obviously considering that the company hasn't defaulted its debt in its history, right? Because
not necessarily, right? Why does it matter that they've defaulted?
Well, because a company that restructures their debt might have a better interest ratio.
Right. That's perfectly okay. You're lending to the restructured company, not to the old company. Cost of debt is an updated cost of debt today, right? So you can have a company that went bankrupt. Every airline has gone bankrupt at some point in time in its history, right? But when I lend to United today, or American today, or Southwest today, what I care about is, what does it look like today? Is your question about the interest coverage ratio not reflecting the restructuring? Because it's restructured, the interest coverage ratio should reflect that as well, right?
But do rating agencies take the same approach?
In terms of, no, look at the airline ratings. If history, I mean, do they consider history? Yes. But if you have great interest coverage ratio as an airline, you're going to get a good rating, notwithstanding your history. If you're permanently tainted as a company, once you go bankrupt, you'd never be able to borrow money as an airline. Right? So restructurings change. I mean, you're lending to a very different company if it's restructured. So the company's history is not going to be the key factor in whether you're lending. You might, it might play a role in credibility of the company and the business it's in. But you're lending to the restructured company, not to the old company. Nabisco, when defaulted on its debt, came back with a new company, new rating, an entirely different game. So let's talk. Yeah, go ahead.
Another question here. You mentioned companies outside the US get a portion of
country defaults.
Country
Just
default.
do the entire one. Don't even do a portion, because we have an Indian company. So basically, we're building up to a cost of debt. Start with a risk-free rate in rupees, add the default spread for the company, and add the default spread for the country. And in a strange way, you're just reversing what you did to get to the risk-free rate, right? Because the government bond rate included the spread. So in a sense, what you're doing is you're taking the government bond rate and adding the default spread for the company to it by doing it. But it is part of life. Is when you borrow money, you are afflicted. But I mean, I feel sorry for that poor Venezuelan company that's still trying to borrow money.
You had 2/3 in here.
Yeah.
Is that sort of arbitrary? Is that what you found?
It's like a lambda. It's, I don't even try to do it anymore because it's just so messy to do. I actually, in 2003, found companies like Embraer and looked at their actual cost of debt relative to Brazil. But it's so much work to do and so tedious. I've stopped doing it. I just add the entire default spread for the country now.
Okay, thank you.
Yeah. Go ahead, Anurag.
I wanted to know if it matters what currency the debt is in. Let's say, you're an Indian company.
That's why I said the level of the risk-free rate matters, right? If your default spread is 3% and your risk-free rate is 2%, and you're now moving to a risk-free rate of 20% from 2%, obviously you're going to charge a much higher default spread than 3%, right? So if you're actually worried about the level of the risk-free rate being very different, one simple adjustment is to take the default spread you get from this table, which is $1 default spread, and scale it up. It's the same inflation effect we talked about with the risk-free rates, is adjust the spreads for the same inflation effect, which is if your inflation is 15% minus 3%, take the default spread, multiply by 1.15 divided by 1.03, it'll scale up all the spreads for the much higher risk-free rates. Or do your entire analysis in dollars and then do the inflation adjustment on that. That will adjust everything, risk premiums and default spreads for the much higher level of rates.
So if a company, say an Indian company, is raising debt from an Indian financial company, did it still need to incorporate the...
You can't use my default spreads in. So if the question was, India has a ratings agency called CRISIL, which has been around, it's well regarded, but it rates only Indian companies. A AAA from CRISIL basically means relative to other Indian companies, this is an extremely safe company. So using CRISIL ratings, you're actually getting a company default spread that is India specific. You'd have to look up the default spread. You can't take my AA spreads and apply it to a CRISIL AA. It doesn't work. So unfortunately, I don't maintain those spreads. I don't have the data to do it. So if you want to use an Indian ratings agency as your basis, then you're on your own in terms of coming up with default spreads based on that, because I don't have a lookup table for that, unfortunately. It's not difficult though. Go find other companies with similar CRISIL ratings, see what the rates on their bonds are, and see if you can back into a default spread. Ziki?
Hi, Professor. It's also about the 2/3. So right now, if I were calculating the cost of debt, do I just add the country default spread?
Just add the entire country default spread on.
And the company? Just add those two?
And the companies as well. So basically add the country and the company. And that's the default built into the FCFF Ginzu simple spreadsheet that I sent you, because you pick the country and I automatically look up the default spread and add it on. So it's happening already in the background. It uses synthetic rating from there.
Okay, got it. Thank you.
Okay, so let's go back to the cost of debt. So cost of debt is the rate at which you can borrow money long-term today based on your credit risk, right? But let's say your company has access to subsidized debt. Why would somebody lend me money at a rate below the market rate? Sometimes governments do that, right? Because they want to encourage a certain export businesses, green energy. I want to ask a question about what to do when you have subsidized debt. And I'm going to use Embraer as my example. If you remember, the cost of debt that Embraer should be paying, given their risk, is 9.29% on their dollar debt. Embraer was actually being lent money by the Brazilian government at a 6% dollar cost of debt. It was subsidized. Why? Because Brazil was proud about the fact that they're an aerospace company and they wanted to give them. So my question is a very pragmatic one. When you compute cost of capital for Embraer, let's assume all their debt is subsidized. It wasn't, but let's assume it was all subsidized. Should I use the 6% subsidized cost of debt as my cost of debt? In which case my cost of capital will be much lower. Should I use the 9.29% cost of debt as my cost of debt, the market rate, which would make my cost of capital higher? Or is there some solution in the middle that you would pick for the company?
I'd go for B.
You'd pick B? And then what about the subsidy then? Because there is a real benefit you're getting, right? I would pick B as well, but I can't ignore the subsidy. Is there a way you can value the subsidy?
Isn't the cost of debt the opportunity cost?
Yeah,
and so we're going to use the market rate.
No, I agree with the rationale for using B, but I'm saying, notwithstanding that, there is still this, for the value of the company is being pushed up because they are given subsidized debt, right?
Would you reflect it in your cash flows in some way? In interest?
There's an easier way to do it, right? If you take this bond, which has a 6% rate, but let's take the debt as 6% rate, right? The true market rate is 9.29%. So if you take the debt and you revalue it using a 9.29%, you're going to get a much lower value for the debt. That difference is effectively the subsidy. The Brazilian government is subsidizing you by 320 million by giving you debt on which they should have paid only 680 million. They've actually paid $1 billion. So, and that's the reason I think it's a better solution than building the 6% into your cost of capital, is because you're right. You're violating a basic rule, which is this is not the rate you can borrow money at outside. And second, you're running the risk of locking it in forever. And the danger there is subsidies end at some point in time. So I think that the right solution is to continue to use the 9.29%. So Tesla,
and then
yeah,
and take the subsidy as the absolute amount and just subtract from the value. Yeah, sorry, add on to valuation.
It's cleaner. It's a much cleaner way to deal with subsidies. In fact, in general, any kind of subsidy you get from the government, it's better to keep it out of the valuation, value it separately. So you know how much of your value is coming from that subsidy and how much will disappear the minute the subsidy is taken away. A lot of the auto companies now, for the next few years, are going to get a subsidy from the federal government, right? Because every time you buy an electric car, you know, I don't know how the end law turned out. Originally, it was going to be, it was made in the US, an electric car made in the US. There are those subsidies add to your value as an auto company. The question is, how much do they add? And what effect will it have on your value? So you got a cost of equity, you got a cost of debt.
Yeah, are you potentially double counting that because it would also show in the increased cash flows?
No, not really, right? What cash flows do we discount with the cost of capital? Pre-debt cash flows. If you were doing free cash flow to equity, we wouldn't be doing cost of capital in the first place. Then you're right. That lower interest expense would push up your net income. But because you're looking at operating income free cash flow of the firm, that subsidy is not shown up in your cash flows yet. But that's a good question to ask. Have I already counted that in my cash flows? And if you're doing equity valuation, you probably have counted it in by pushing up your net income with the lower interest expense. Let's talk about the last piece, the cost of capital. What weights should I use? I'll give you the choices. You probably already know the right choice, but then I'm going to put you on the spot and ask you to justify what every corporate finance textbook asks you to do it as religion. So here are the choices. First is you could use book value weights. Book value of equity, book value of debt. It's right there, right? Shareholders' equity is book value of equity. The second is you can use market value weights. Market value of equity, market value of debt. What does every finance textbook suggest you should use as weights when you do cost of capital? Book value, market value.
Book value.
Really?
Market
value. And I want to make sure that book is burnt to the ground because it's market value. It's always market value weights. So I want to ask you a question of why we push that. because it seems like religion. People talk about it, and you ask them, why do you use market value weights? They don't seem to have a good reason. So let's see if you can give me the reason. Is it because the market is usually right? What's the danger of opening that door? If you say the market is right, that's why I'm using market value weights. Tell me what you're doing with the cost of capital. You're using it to value your company, come up with a value per share, which you're comparing to the market price, and telling me the market is wrong. And I'm going to come back and say, but you told me the market is usually right. Don't put yourself in the spot of having to justify the market being right. It's not that. Could it be that market values are easy to get? Yeah, book values are just as easy, right? They're both easy to get. Is it because book values of equity and debt are meaningless? If you truly hate accountants, you'd buy into that statement. And even I don't buy into the statement. They're not quite meaningless. They're meaningful. We can debate how meaningful. You want to know the real reason we use market value weights? It's because every discounted cash flow valuation is an exercise in acquisition valuation. You're acting like you're buying the entire company in the market today. So tell me what you'd have to pay for shares. You'd have to pay the market price, not your estimated intrinsic value, not book value. If you wanted to buy out all the debt, you'd have to pay market value. This is a transaction-driven view. That's what drives cost of capital. Market value rates are driven not by the perception the market is right. That's why we can get away with the inconsistency of using market value weights to get a cost of capital and end the valuation by saying, I got an intrinsic value per share that's higher than the price per share. So file that away. If somebody asks, why do we use market value weights? Don't dance around. Don't talk about market efficiency. Don't tell me the market is right. It's really about what you're trying to do in a discounted cash flow valuation. So it was a long journey. We're at the destination. I want to compute a cost of capital for Embraer, which I've done in bits and pieces through the last 100 pages. Start with the cost of equity. First, I'm going to do everything in US dollars. I made the choice because in 2004, there were no Brazilian government REI bonds. I didn't even have a choice of doing a nominal REI valuation. So my risk-free rate was the T-bond rate, 4.29% then. To get my cost of equity, I got a beta, and that was a bottom-up beta for Embraer based on global aerospace companies, multiplied by a mature market premium, and then brought in the country risk through a lambda and a country risk premium. And of course, if I wanted to do this in one step, I could have done a weighted average equity risk premium, cost of equity of 10.7%. Cost of debt we just went through, T-bond rate plus default spread for the country, 4%, plus default spread for the company, 1%, 9.29%. Market value of equity, share price times number of shares was easy. Market value of debt is often very difficult to get directly. You know why? Because much of debt is not traded, it's bank debt. Even companies that issue bonds will often have debt that's not traded. Then investment banks, you know what the rule is, right? Because debt is so difficult to get a market value for, you'll often see people use book value of debt as a proxy for market value and say, it won't be that different. And 95% of the time, you're going to be okay until you run into a Bed Bath & Beyond. And what's the market value of debt at a Bed Bath & Beyond going to look like relative to the book value of debt? Much lower or much higher? Much lower, right? The book value of debt reflects what they're expected to pay, but because you're in so much risk, you're not sure you're going to see a market discount. So here's what I'm going to do to convert book value of debt to market value. It's a neat little trick. File it away even if you don't use it. Sometimes you'll find it useful. The book value of debt at Embraer is $1.953 billion. That came off the balance sheet. Their interest expense came off the income statement was $222 million. The maturity of the debt, which came from the footnotes, was 4 years. So here's what I know. I know the book value of debt is $1,953 million. I know the interest expense is $222 million. I know the debt comes due on average in 4 years. And I also know what the current market interest rate for debt should be based on my pre-tax cost of debt calculation, 9.29%. I treated the debt on the books as if it were a gigantic coupon bond. So hang in there with me. How do you value a coupon bond? You take the present value of the coupons And then you add the present value, the face value. The coupons here are 222 million a year. I take the present value of a coupon every year for 4 years at 9.29%. So in the calculator, you're entering 929 as your payment, N is 4 years. Discount rate is 9.29%. You hit the present value, you're going to get a present value of 222 million for 4 years. The 1,953 million is like the face value of the bond. It's coming in at the end of the 4th year. I discounted back 4 years at 9.29%. I add the two numbers up. I've converted my book debt of 1,953 million to market value of debt of 2,083 million. I'm home free. I've got an equity value and a debt value. I take a weighted average. The weights turn out to be that equity and debt value, right? 84% equity, 16% debt. My cost of equity is 10.7%. My pre-tax cost of debt is 9.29%, which I then proceed to multiply by 1 minus a tax rate. First, why am I doing this again? Why, with equity, I don't seem to be why am I multiplying my cost of debt by 1 minus the tax rate? Ed?
Is it paid pre-tax?
Because 9.29% is what I pay pre-tax, and what does the tax code in much of the world allow me to do?
It's that give you a tax shield with
claim the interest expense as a tax deduction, right? I'm reflecting that. Equity, it's extremely unfair because if I have to pay equity investors, it's got to come out of after-tax cash flows. But with debt, it's almost like the government bends over backwards saying, borrow more money. Which then leaves me with the pragmatic question of, hey, what tax rate should I use? You're saying, what do you mean, what tax rate? You have a choice of 2 tax rates. One is what's called an effective tax rate. Anybody want to define for me what an effective tax rate is? Meredith, what's an effective tax rate?
Is it not just the interest expense or, sorry, the tax you currently pay on your earnings each year?
If you go to the income statement, the accrual income statement, there's a tax line item and a taxable income line item. It's it's accrual taxes divided by accrual taxable income. Basically, do any of you use TurboTax or a tax software to do your software taxes every year? I do. I've done it for a long time. And it always pisses me off after I've gone through and input the numbers. At the very end, here's what TurboTax will come in and say. Congratulations, you're done with your taxes. This year, you paid 27.83% of your adjusted gross income in taxes. And what they do is they take your total taxes paid, divide by the adjusted gross income, which is my version of taxable income, and report a tax rate. That's like an effective tax rate. Companies do that all the time. They take taxes paid, divide by taxable income. So think of it as an average tax rate across all your income. What's a marginal tax rate? The key word is marginal. So what does the word marginal indicate? Daniel, you want to give that a shot? What is the marginal tax rate?
It's the tax paid on the last dollar of earnings you made.
The tax paid on the last dollar of earnings. And where would I get that? Let's say you're in the US, you're a US company. What's the tax rate I pay on the last dollar of my income? I'm going to start with the federal tax code, right? What's the federal tax rate on corporate income?
21%.
21%. It used to be 35%, one of the highest tax rates in the world. It's now 21%. Am I home free as a company? I pay federal taxes. But the US actually has this 3-tier tax system, right? States often have corporate taxes, well, depending on which state you're in. California is a state corporate tax. And sometimes you can have local corporate taxes. You're in LA, you can have a local corporate tax. In the US, if you add state and local to the federal, you end up with about 25%. That number can be closer to 21% if you're Texas-based and you have very low corporate taxes. It can be as 27% in New York and California, but it's about 25%. The average effective tax rate for US companies last year was about 18%. So the question I'm asking with the cost of debt is, which of those 2 tax rates should I use to get the after-tax cost of debt? Should I go with the effective tax rate, which is going to be 16, 17, 18, or even as low as 9% for some companies, or should I go with the marginal tax rate?
I think marginal
effective.
tax rate.
I heard one effective, one marginal. So I'm going to give each of you a chance to explain your answer. So let's start with the marginal tax rate person. Give me the reason for using a marginal tax rate. I couldn't tell who it was.
Yeah, so it was me. So
Yeah.
I think it's marginal because if you think if there is no debt versus there is debt, you are paying the marginal tax on the addition. You are saving the marginal tax on the interest, basically. So
again, let me use TurboTax to illustrate the point. Let's suppose you have $1 million in taxable income. If I'm insulting you, add an extra zero, make it 10 million if that makes you feel better. Let's say you have $100,000 in interest expenses. So tell me what happens. You take the million, you subtract out the 100,000, you report $900,000 in taxable income, right? So think of where you saved on taxes. You didn't save on the first 100,000. You didn't save on the middle 100,000. You saved on the last 100,000. Interest saves you taxes at the margin. And I'll give you a very practical example to illustrate this. Apple's effective tax rate last year was about 15%. You know why it's so low? It's because they have income from other parts of the world where taxes are much lower than the US. 10% tax rate countries, 15%. When I compute Apple's after-tax cost of debt, they have about $100 billion in debt. I use the US tax rate of 25%. And here's why. In spite of the fact that Apple has operations all over the world, guess where they borrow money? They borrow money in the US because they don't borrow money in Ireland for their Irish sub. They borrow money in the US. It doesn't make sense for companies to borrow money in low-tax locales. It's a choice. So I'm going to go with the marginal tax rate, even if your effective tax rate is low, because I know you're going to find a way to get the maximum tax benefit on your interest expense. Let the cynic in you come out, because if the cynical part of you says, hey, these guys can figure out a way to maximize tax benefit, you're right. That's exactly what happens. The bottom line here is my cost of capital for Embraer in US dollar terms is 9.97%. So if you're valuing Embraer and it's 2004, you compute this cost of capital, you're feeling pretty good, right? You're done. 2 weeks later, you decide you made the wrong choice. You know what I mean by the wrong choice? You should really have been valuing this company in reais, not in dollars. And you say, what was I thinking? I should have done everything in reais. Sounds like you have to start from scratch, right? So I'm going to give you a quick and dirty way in which you can go from a US dollar cost of capital to a real cost of capital. And this is actually going to be in response to Anurag's earlier point about default spreads and what if you have a risk-free rate that's very different. Do everything in US dollars, in this case, 9.97%. Then look up two numbers. One is the expected inflation rate in Brazil, and the other is the expected inflation rate in the US. It's the same differential inflation we talked about in the context of risk-free rates. What that'll do is almost instantaneously convert your dollar cost of capital of 9.97% into a nominal real cost of capital of 16.44%. It's an incredibly useful trick to have in your back pocket, because it basically means that if you have a cost of capital in any currency and you're talking to a client, you're talking to a colleague who thinks in a different currency. They think in rupees, you're thinking in dollars. You can both start talking apples to apples if you convert your dollar cost of capital into rupee cost of capital. And all it needs is bringing inflation into play. One final point, and this is something that some of you will run into. In my cost of capital, notice there were only two components, debt and equity. And I tried really hard to make sure there are only two components. But sometimes companies can throw curveballs at you. And by curveballs, I'm talking about what I call hybrids. You know what a hybrid is? It's part debt, part equity. And it's in one security. I'll give you two examples of hybrids. One are convertible bonds. Somebody explain to me how a convertible bond works. Jackie, how does a convertible bond work?
A convertible bond means that you convert it into equity.
You don't have to, right? You have the option to convert to equity. And when would you exercise the option? When stock prices are soaring or when stock prices are dropping?
When stock prices are soaring, you can.
In other words, it's a conversion option that becomes very valuable if your stock price keeps rising. At some point, you say, I'm going to become one of those guys, and you convert your bonds into equity. A convertible bond is two pieces to it. A straight bond, because as long as you hold it as a bond, you get coupons like any other bond. You get face value. So you have the choice of leaving a convertible bond as a bond, collecting coupons and face value. That's a straight bond portion. And you got this conversion option, which is really equity. So I'm going to talk about, hey, what do we do with convertible bonds? The other, and this is the more messy hybrid, and thank God most sectors don't use it, is preferred stock. Preferred stock has different meanings in different parts of the world. In Latin America, preferred stock is this common stock without voting rights. In the US, though, preferred stock is more like bonds. Because on preferred stock, here's what you get. You get a dividend that's set up front. So unlike equity, where you get a residual cash flow, in preferred stock, you're promised a dividend, 7%. So it's like very expensive debt. You know why it's very expensive debt? Because unlike debt, where you get the tax benefit from interest expenses, on preferred stock, you get no tax benefits. By itself, preferred stock is an extraordinarily inefficient way to raise capital. It's a stupid way to raise capital. So why do companies do it? You know what the sector that there are two groups of companies that use preferred stock. One is very young companies that issue convertible preferred stock, but that's really not, it's really almost all conversion option. The other is financial service companies. And the reason banks like preferred stock is it allows them to play the regulatory capital game. Now, normally, if a bank borrows money, it suffers in terms of tier 1 capital ratios. The regulators measure their capital ratios, and debt is not counted as part of tier 1 or tier 2 or tier 3 capital. But preferred stock, for whatever reason, is treated by the regulatory authorities as equity, not debt. It's an absurd rationale. But banks can now issue preferred stock, very expensive debt, but because it gets counted as equity, meet the regulatory capital requirement. So if any of you are valuing banks, don't be surprised if there's a third component of capital. You got equity, you got debt, you got preferred stock. Treat it as a third component, give it its own cost. The cost of preferred stock is just the preferred dividend yield, the dividend divided by the price, and you've got it nailed down. But let me go back to the convertible bond, which I said was part debt, part equity, and talk about how you might be able to separate the two components. Let me give you an example. Let's suppose you have a company that has a convertible bond with $125 million face value and a 4% coupon rate. Usually convertible bonds will have lower coupon rates because they give you this option as a kind of a sweetener. And let's say this convertible bond is trading in the market for $145 million. So the face value is $125 million, the coupon rate is 4%, and the market value of the convertible bond is $140 million. And as a final piece of information, let's say if this company has a rating of single A, and that single A rated bonds have an interest rate of 8%. So if this company had issued straight bonds, it would have had to pay an 8% coupon instead it issued convertible bonds. So here's my task for you. You know the total value of the convertible debt is $140 million. You're trying to figure out how much of that is debt and how much is equity. Here's a trick, a neat little trick in which you can separate the two. Shut your eye to the conversion option. Act as if this were a straight bond with a 4% coupon rate and a $125 million face value. Remember how we valued a bond? You take the present value of the coupon plus the present value of the face value using the 8% rate, which is the current market rate. You come up with $91.45 million. You're saying, what does that mean? If this convertible bond were just a bond, there was no conversion option, it would trade at $91.45 million. What's it trading at? $140 million. What's the extra $48.55 million for? The conversion option. You take that, you put into equity, the $48.55, you put the $91.45 into debt. You got rid of the hybrid. It's now debt and equity. You can move on. I've been doing this for 30 years. I heard that IFRS now requires companies with convertible debt to now do it. Eventually, accountants catch on that convertible debt is not 0-1, which magically goes from debt to equity, that it becomes gradually equity as the stock price rises. because the conversion option becomes more and more valuable.
Professor, why would we not do we not treat the call option within the convertible
you could,
the same way?
Because there are two pieces, right? You can either value the option part or the debt part.
Yeah.
Which do you think is easier? I think the debt part is easier. Why bring in a Black-Scholes model to value the option? You're right. That's the other way I could do it, is to value the conversion option and treat the rest as debt. I just think it's easier to value the debt portion. But you're right. I could value the conversion option. In fact, if you don't have a market value, then you might have to value the conversion option with an option pricing model and come up with the value of equity. But
like you do with employee stock options.
Exactly. Yeah.
Okay, got it.
Yeah. So let's recap the cost of capital. So cost of equity comes from a risk-free rate, a beta and equity risk premium. The cost of debt is the rate at which you can borrow money long-term today, adjusted for the tax benefits. The weights are market value weights. Can those weights change over time for your company? Yeah. Which means your cost of capital can change over time. Leave open that door. In fact, I'm going to argue that in most valuations, your cost of capital should shift over time as your company changes. A company with a stable, constant cost of capital should be the exception, not the rule. Any questions on discount rates? Because we're going to put discount rates to rest and start at least on the discussion of cash flows. Okay. So let's start talking about cash flows. I'm going to set the table. Often I hear analysts talk about free cash flows. You go to Bloomberg, it says FCF. You go to Capital IQ, it says FCF. And I'm always left puzzled because FCF is incomplete, right? To whom? To equity or the firm? So let's set the table. Free cash flow to equity versus free cash flow to the firm. Free cash flow to equity is an after debt cash flow. Free cash flow to the firm is a pre-debt cash flow. And if you look at the calculation, I've set them side to side so you can see what you do in parallel and what you do differently. Free cash flow to equity starts with net income. Why? Because it's an equity cash flow. I'm looking at equity income. Free cash flow to the firm starts with operating income because it's before interest expenses. Free cash flow to the firm, I actually have to compute a hypothetical tax on that operating income because the taxes in the income statement reflect interest expenses being tax deductible. So net income is the starting point for free cash flow to equity. After tax operating income is the starting point for free cash flow to the firm. And then in both calculations, you subtract out what the company is reinvesting. In what? Both long-term and short-term assets. To measure what it's investing in long-term assets, I'm going to take the difference in capital expenditures and depreciation. Why the net effect? Because depreciation is an operating expense, but it's not a cash expense. It pays for some of CapEx. It's called net CapEx. Net CapEx measures what you're putting into long-term assets. And change in non-cash working capital measures what you're investing in inventory, receivables, short-term assets. First, let me ask you a question. Do you have to reinvest as a company? Is there some law that says you have to reinvest? No, you can put no reinvestment. So if you show me a company and you say, I'm not reinvesting anything, I'm not going to fight you until I get to your growth rate. You know why I'm going to fight you there? Because if you say my company will grow 20% a year and I'm reinvesting nothing, I'm going to say, well, how the heck do you pull off that magic? The assumptions you make about reinvestment are tied to your growth assumption. We'll talk about the explicit tie, but reinvestment is what you're putting back in the firm. When you do free cash flow to the firm, you subtract out reinvestment, you're done. But when you're doing free cash flow to equity, you have one final cleaning up to do. Think like an equity investor. When you take on new debt, when you borrow money, the minute after the borrowing is approved, what happens? Cash comes into the company, right? From the lender. And every time you repay debt, that's cash leaving the company. So the final element you're going to see in free cash flow to equity that you will not see in free cash flow to the firm is this net debt cash flow. How much am I borrowing? That's a cash inflow, minus how much am I repaying, which is the cash outflow. So keep this page handy because you're going to see people being extraordinarily sloppy about free cash flows, and you want to hold them accountable and say, what cash flow are you computing? Are you being internally consistent in how you're computing free cash flows? So if you're going to break down free cash flow computations, I break them down into 3 steps. First step is you need earnings, right? Net income or operating income. which means if your accountant is playing games with you, you're screwed, right? Because your earnings number is screwed up. Everything else is going to be screwed up. We're going to talk about accounting fraud and why evaluation can't tell you about accounting fraud because it's built on accounting earnings. We'll talk about some of the checks you can run, but that's your starting point. Second, you got to figure out how much your company is reinvesting to grow. And third, you got to look at these cash flows from debt. So let's start with, by setting this up, at least in generic form. As you go through the past quizzes, and this is my unhappy duty to remind you that your first quiz is a week from today. So I'll send you, I've sent you the practice quiz, the review session. And as you go through the past quizzes, you'll see me compute free cash flow of the firm. And you're going to keep thinking, there are a dozen different ways this guy seems to be using to compute free cash flow of the firm. There's only one. But algebraically, I can take that one way of computing free cash flow and express it in different ways. Let me explain. The long way of computing free cash flow of the firm you just saw is after-tax operating income minus this CapEx minus depreciation plus change in working capital. That's a correct computation. That's what you see in every textbook. But what if I took this number, CapEx minus depreciation and change in working capital, and consolidated and called it reinvestment? It's the same thing, right? I'm just consolidating the numbers. After-tax operating income minus reinvestment is free cash flow of the firm as well. So if I give you a problem and I say the reinvestment is 50 million, the reinvestment includes net CapEx and change in working capital. Or I could take the reinvestment stated as a percentage of the after-tax operating income and say 30% of your after-tax operating income is reinvested. I'm saying the same thing, just in different form. Ultimately, all free cash flow of the firm are after reinvestment, but how I get there can be different depending on whether I did the long way, the shortcut, or using a ratio. But in all of these computations, there's one thing that you're going to see missing. My free cash flow of the firm does not include the tax savings that I get from interest expenses. I'm open about this. I don't include it, which is strange, right? Because that's a real tax savings. So why am I excluding those tax savings from interest expenses when I compute free cash flow of the firm? What is my rationale for excluding it?
Because this is free cash flow to firm and not equity holders. So we are not actually.
But where does it interest? Do I just ignore it? Does it disappear into thin air? I mean, I have to show it in my valuation ultimately, right? So if it's not showing up in the cash flows, where's the only other place it can show up? What do I discount these cash flows back at? What do free cash flows of the firm get? What discount rate do you use for free cash flow of the firm?
What?
The weighted
cost
average.
Cost of capital. And what goes into a cost of capital? We just went through the calculation. Cost of equity and a
pre-tax cost of debt.
No, not a pre-tax.
After-tax cost of debt.
The tax benefit from interest expenses shows up in my discount rate. That's why I don't count the same tax, because that will be double counting, right? If I increase my cash flows to the same tax benefits and I lower my discount rate, I'm double counting. That's why the tax savings from interest expenses should not be part of your free cash flow of the firm.
No. Why do you do that? Is it because the tax savings are sort of
because I have to show it somewhere, right? What's the alternative? If I wanted to show my tax savings in my cash flows, what should I use as my cost of debt when I do cost of capital?
Pre-tax.
Pre-tax cost of debt. You can do it either way. I think it's easier to adjust the discount rate because then you can capture the fact that I might have to wait 3 years. So you can pick one or the other, but you got to pick your poison. You can't do it in both places because that'll be double counting. But you're right. I can count the tax savings in my cash flows and then use the pre-tax cost of debt in my discount rate to make my discount rate higher.
And does your method kind of give a cleaner view of the cash the business is throwing off as opposed to
is it cleaner though? Because often people describe the free cash flow of the firm as an unlevered cash flow, which is the cash flow you would have had with no debt. The minute you start adding the tax savings from debt to the cash flow, you can't use the word unlevered anymore because clearly the leverage is affecting the cash flow. So to the extent that you want your free cash flow of the firm to be an operating cash flow, unaffected by your leverage choices, it's probably better to keep it in the discount rate.
Yeah.
Because then you can keep the two things separate.
Makes sense.
Talk about free cash flow equity. Again, I'm going to lay out all of the different pathways I can get to free cash flow equity. The long way, I start with net income, subtract out reinvestment, then bring in the cash flows and debt. That's what you saw as my calculation. The second, I can take the change CapEx minus depreciation, change in working capital, call it reinvestment, bring in the net debt, cash flow, come up with free cash flow equity. Or I can make the net debt netted out against reinvestment called equity reinvestment. Effectively, all I'm saying is when you see these different terms, my end game is still the same. I want to come up with after debt cash flows. So if you find one of these equations confusing, just go to whatever equation you find comfortable, because if you do it right, you should get exactly the same answer, no matter which pathway you use. Ultimately, free cash flows equity should be after all debt cash flows. So I'm going to send you a link to a blog post I wrote in October of 2022, because I got sick and tired of seeing FCFFs and FCFEs on equity research analysts' reports that were neither FCFFs nor FCFEs, because people were messing up on every single dimension. So I took Microsoft and I used it to illustrate so basically you see links to the financial statements. So it's very pragmatic. So this is where I went to the statement of cash flows. This is what I did. And essentially I go through both the free cash flow of the firm calculation, that's what you see to the right, and the free cash flow to equity calculation for Microsoft. By itself, this chart tells you nothing, but read that post, because if nothing else, it'll make you comfortable with what you're doing differently in the two approaches and why it's dangerous to mix and match. So let's get started on getting cash flows right. Okay. So when you think about getting cash flows right, clearly the starting point is earnings. That's why I said, you got to trust accountants at least a tiny bit to do free cash flow of the firm, because the earnings numbers are coming from that. I already talked about updating. I'll add a couple more things to it, but you want the most updated earnings you can. Trailing 12-month numbers work fine. In some cases, I've actually used unofficial numbers, because until recently, there were some parts of the world where you didn't get quarterly reports. You got these bits and pieces of reports. I want the updated numbers. In some cases, you might find yourself normalizing numbers. I'll come back and talk about this more in the next session. You're saying, when would I do this? Oil companies were the most profitable companies in the world last year. And that just 2 years ago, oil companies were among the least profitable companies in the world, 2020. You think, what changed? What do you think changed? What's the difference between 2020 and 2022 that explains the swings in oil company
oil prices?
Oil prices.
Demand.
Right? So you can already see when valuing an oil company, if I use my base year numbers, they happen to be a really good year, I'm going to overvalue companies. And if I use my base year number, it turns out to be a really bad year, I'm going to undervalue companies. So simple fix is, hey, rather than use last year's numbers, why don't I normalize? Easier said than done, but you're trying to average earnings across the cycle. So commodity companies and cyclical companies, sometimes you might replace last year's numbers with a normalized version. But there's one thing you need to do whenever you use earnings, and that is clean up after your accountants, because internally they have these inconsistencies that can affect what you see as earnings. I've kind of opened the door for that a little bit when I talked about R&D with the start of the class. I said it's really a CapEx. They treat it as an operating expense. And until 2019, there was a financial expense that accountants routinely categorized as an operating expense. You know what I'm talking about? They do it finally. They've come to their senses. What's a financial expense that pre-2019 was treated as an operating expense?
Leases.
Operating leases. It was, I never understood why they did it. Finally, they came around in 2019. So I want to talk about cleaning up after accountants, but let me do a quick stop on updating. Why do we update? Because we want to value companies as of today, not as of 6 months from now and 9 months ago. And for younger companies, it's critical that you update, get the most updated numbers you can. And to get trailing 12-month numbers, Many of you might think I need 4 quarterly statements, which is a pain in the neck. All you need is 1 annual report and your most recent quarterly report. If you have the most recent annual report and the most recent quarterly report, computing trailing 12-month is a simple exercise. If you don't believe me, I think this week's Valuation Tools webcast will show you how to get to trailing 12-month from a 10K and a 10Q or an annual and a quarterly report. It's not difficult to do. I don't know how many of you have signed up for Capital IQ yet. I hope most of you have. If you haven't, please use your access. It's free while you're an MBA student. It's no longer free once you leave the school. But the nice thing about Capital IQ is it actually gives you the trailing 12-month numbers. So you can actually, they do it for you. Use the most updated numbers. But I have a bigger task in front of me, which is I want to clean up after my accountants. And as I said, there are 2 items on which I worry. One is this financial expense that accountants have routinely miscategorized as an operating expense. I'm talking about leases. And the second is capital expenses like R&D that they've routinely miscategorized as operating expenses. So I want to take you through the process of capitalizing both. You're saying, why bother with leases? They do it. I want to give you a window on what accountants are doing with leases now that they always should have been doing. So you can get a sense of what exactly are accountants doing when they capitalize leases. So let me set the table on leases. In some businesses, leases are not a big deal. This is not a big issue. But in some businesses, they're a huge deal. So here's what I did. I went into companies' financial statements and looked at lease expense as a percent of sales, because that's going to give me a perspective in which sectors is this a big issue. The top, air transportation. What do they lease?
Airplanes.
Almost every aircraft is leased. No airline buys its aircraft. It leases aircraft. Trucking, trucks are leased. They're not bought. Restaurant and dining, they lease the spaces. Retail. These are the businesses where leases are a big deal. So I'm going to start by giving you my rationale for why leases have always been debt, notwithstanding the accounting mistreatment. I mean, here's how I think about debt. Debt is any source of capital that gives rise to contractual commitments. You know what I mean by that? You take a bank loan, there's a contractual commitment. You got to make interest expenses. You issue corporate bonds, there's a contractual commitment to pay coupons. When you sign a lease, a 10-year lease as a retail store, did you enter into a contractual commitment? It's not a trick question. Of course you did, right? You signed that contract agreeing to pay $1 million every year for the next 10 years. In what universe is this not debt? Leases have always been debt. We can argue whether it's senior debt or secured debt or less secure debt, but leases have always been debt. So for 30 years now, on my data sets, I've always capitalized leases. I couldn't wait for accountants to come to their senses. And here's what you need to do to capitalize leases. You take the contractual commitments you've already entered into. You take the present value of those commitments. So if you tell me you have contractual commitments of $100 million every year for the next 5 years, I'm going to take the present value of those commitments using the pre-tax cost of debt as my discount rate. I'm going to end up with a debt value of leases. I'm going to put that on my balance sheet. Now, balance sheets have a very unpleasant requirement, which is that they have to balance, right? So if I put a $500 million lease debt on my balance sheet, what do I have to do on the other side to make balance sheets balance? I've got to create a counter asset, lease asset. And once I create an asset, what do I have to do in subsequent periods? To depreciate the damn thing. You're saying this is a pain in the neck? You're right, it's a pain in the neck. But you have to do it. Which means when you capitalize leases, you're going to see the following changes. In your balance sheet, you're going to see debt show up, which wasn't there before. Your operating income now has to get restated because you no longer can subtract out the entire lease expense, because you can subtract out only the depreciation portion of it. Everything changes when you capitalize leases. So as the final exercise for today, here's what I'd like to do. I'm going to take you through a company where I capitalized leases. I actually did this for this company 25 years ago because they thought that an accounting change was imminent. Now, this is almost 20 years ago. They thought an accounting change was imminent. First thing I said when I walked in was, I said, an accountant's definition of imminent is very different from the definition for the rest of us. Because this was in 2003. You know when that imminent change actually occurred, right? It happened in 2019. Now, but they were worried it might happen in 2004. So they said, what will happen to our numbers? We capitalize leases. So I took them through the process. I first took the lease commitments they'd entered into. And US companies have had to show this in the footnotes for as long as I've been looking at footnotes, for 40 years. I took those lease commitments. So these are not expected lease payments. These are actual contractual commitments, discounted them back at the pre-tax cost of debt for the gap, which was 6%. What I got as a present value is $4.4 billion. That's now going to show up on my balance sheet as debt. And wherever I use debt in my calculations, like in the cost of capital, you're going to see me add the 4.4 billion to that conventional debt. The total debt for the gap is much greater than what you saw on the balance sheet. I also restated their operating income. I took their actual operating income, which is about $1 billion, added back the lease expense. Why? Because I should never have subtracted it out in the first place, not an operating expense. And they're saying, what's this 4,397 divided by 7? See this 4,397 debt value? It creates an asset, right? With a 7-year life, because that's what the lease commitment is. I said, I'm not playing games with my, accelerated depreciation sum of the year. I just took straight line depreciation. So this is the asset being depreciated over 7 years. So you add back the lease expense, subtract our depreciation, you get an adjusted operating income. If you're really in a hurry, there's a shortcut you can use, but it's only if you're really in a hurry. You can take the operating income and add back the imputed interest expense you'd have had on the debt, because if you claim it's debt, there'd have been interest expense. Do it only if you're in a hurry. The first approach with 1,362 is the right one. So I'm going to leave you with a final table, because this is the table I showed the gap. And they went through various stages of delirium as I showed this table, because initially they thought I was giving them good news, and finally they had no idea what I was. Then they thought I was giving them bad news, and finally they had no idea. So I gave them the good news first. I said, if accountants capitalize leases, you're going to show higher operating income, right? 1.012 will become 1.362 because you're adding back the lease expense, subtracting our depreciation. They were very happy. I said, but there's some bad news. On the balance sheet, instead of showing 1.97 billion in debt, you'll be showing 6.4 billion debt. They were a little worried, look more levered. And I said, but that's good news on a cost of capital basis. Because you have more debt, your cost of capital will go down from the 7.31% I thought it was. Now they were hitting the roof. They thought, this is great. I have higher earnings. I have lower cost of capital. Life is good. And I said, there's one final catch. The way we measure quality of investments, we compute the return on capital you make on the investment, and we compare to the cost of capital. If I stayed with conventional accounting, all I counted in return on capital, which, because you look at book value of debt, is the 1.97 billion. The return on capital I get is 12.9%, which is better than the 7.31%. If I capitalize leases, my return on capital drops fairly dramatically to 9.3%. At this point, they didn't know whether they were coming or going. So what does this all mean? I said the net effect, the spread effect, instead of looking like you're making 5.5% more than your cost of capital, you're really making only 3% more than your cost of capital. That net effect will dominate. And I actually value the company using both, and it turned out the value per share that I get for the gap is lower after I capitalize leases because the spread dropped by so much. So it depends on the company. For some retail firms, capitalizing leases will push up value. For some, it'll leave value relatively unchanged. For some, it'll drop value. And the reason we capitalize leases is to get a much better sense of both what you owe, which is a good thing to know, as well as what you're making on your projects. So when we come back on Monday, and we'll be back in class, we'll talk about capitalizing R&D and how it plays out. And again, the intent is to get a much better measure of, hey, what am I really making on my investments? Because it's almost impossible to value a company if you don't have a sense of that. So I will leave you with that, and I'll talk to you next Monday. Yeah. So have fun, folks.
Thank you.
Thanks, Professor. Thank you.
Thanks.
I'll stay on for about 5 minutes if you have questions. Andrew, you have a question?
Thank you. Yeah, hi, Professor. Want to ask a quick question about like how you recommend, what you recommend is the best way to prepare for the quiz next week.
Well, do a lot of prompts. Here's the one thing you cannot do. Don't just review the notes and say, I kind of get this. I'm going to be okay, because you're going to get to the quiz. It's open book, open notes. You don't have to memorize equations, but if you never work through prompts, you're going to be in trouble. So first step, review the slides, right? Get a sense of the material. Then go through the practice quizzes. The first one or two, you can use the solutions as a crutch, right? So you can check it, but then try to use the solutions less and less, and have at least one or two that you take without looking at the solutions with a 30-minute time frame. So I would say at least 6 quizzes is a good idea. So 2 that you do with complete support, 2 which you do with partial support, and 2 without any support. Because I think that's probably the best way to get ready.
Okay, cool. And is this quiz like in person, like in the auditorium?
It is in person. Everything is in person.
Okay, got it. Thank you.
Okay.
Professor, yes. I got a question at the size 109 about when we decomposing the convertible bonds. Like, the goal we're trying to do that is depositing it into the debit and the equity and in the market value version. But here, when we do that as the method we mentioned in the slide, it seems like we put the debit to the present value, which is basically...
That is always present value. So if you issue a bond, what's the market value of a bond? It's the present value of your payments. It's always present value. Yep. That is never book value. That's why with Embraer, I converted the book value into a market value. So when you do debt and a cost of capital, don't show what you owe based on the balance sheet. You got to convert that into an estimated market value.
Right.
So that's always the end game. So this is not the exception. This is what you do with all debt, not just convertible debt. All debt, normally the market value of debt can be close to book value, because we take, if this bond had been issued at a fair market rate, let's say there was no conversion option. Let's say it issued the bond with an 8% coupon. What would the present value of the debt be? It'd be exactly equal to the book value. The reasons market value and book value vary is because you borrowed money at a rate that's different from the market interest rate today.
Oh, yeah. Yeah. So in this method, we still have the market value of debt and the equity of the convertible bond.
Exactly.
Okay. Thank you.
You're welcome.
So what? Another question. What we do here is just about we want to separate it, and at the end of the day,
throw the equity in with the market cap of equity to come up with the total value of equity to use in the weight. You take the 91.45 million, add it onto your other debt to come up with the debt portion. That then becomes a weight for your debt and equity in your cost.
Oh, that's a weight when we capture the cost.
That's where it matters.
Yeah, yeah. Thank you. Thank you so much.
Professor, I will take my question next time. My question was more on capitalization of leases.
Let's wait till next time, because I will start next session with capitalization of leases. And I'm going to expand and argue that it's not just leases, that any kind of contractual commitment is debt. And I'll give you examples. Netflix.
Yes.
When it gets the rights to the Seinfeld show for the next 5 years and agrees to pay $100 million every year for the next 5 years, is effectively borrowing money.
Yes.
Right. So I'm going to argue that this is any time you have a contractual commitment over many years, you got to treat it as debt, because effectively you've locked yourself in. You've used up some debt capacity. I don't know what PSG pays Messi, but I'm going to look it up before I come to class. But I think they pay him, what, 30 million a year for the next 3 years? Or what, in fact, even better is what Ronaldo is making from Al Nassr. I think he's making, what, 50 million for the next 5 years?
Yes.
That's effectively borrowing money. It's a contractual commitment. You got to pay it in good times and bad times. So basically it becomes like that.
So, Professor, these days we have cloud subscriptions and we pay for cloud. The challenge is
if it's a renewable subscription, it's not debt. If it's a subscription, you've locked yourself in for multiple years.
So I've locked myself for next 3 years but I'm paying it monthly.
Doesn't matter. right? It's just
FSAB doesn't count that way because I was working on.
Right? And as I said, I don't care what accountants do. From a valuation perspective, you borrowed money.
I wanted to pay my $3 million from capital money rather than O&M money, but I ended up paying with O&M last year.
And I'm not saying you did a good thing or a bad thing. I'm just saying you have a contractual commitment. I'm going to treat it like that.
So we should talk to FSAB something to fix them.
No, don't waste your time because you can do it yourself. Why do you want them to do the right thing? I'd rather than them give me the right the raw data so I can do it myself. No, it is
the thing is that Conard follows the rules from FSAB, and our accounting team doesn't budge. They don't give us a capital treatment, so that becomes a challenge every year that we face.
You got to fight that fight. It's not easy to fight. It takes them forever to change.
Thank you.
Oh, Professor, I just remember that during the explanation at the class, one of our classmates said that we can use the Black-Scholes model to capture the option value of the convertible option. But if we use the Black-Scholes model, I think it's not the market value of the option, of the treated as a equity part. If the Black-Scholes model, I think we measure its intrinsic value of this convertible option.
Same thing. Why are you drawing a line between intrinsic and market value? And unless, you could argue the bond that we just valued is not a market value, it's an intrinsic value, right? So if you want to play that game, that basically means that you have no moorings at all because the weights are supposed to be market value weights. You're saying market value is not equal to intrinsic value, then everything has to be intrinsic value, right? Market cap is not intrinsic value. We use it anyway. Why do we use it? Because that's what you have to pay in the market today. This is So I don't think that's a big issue.
Okay.
We know the total value. All it means is you're putting more into one and less into the other.
Oh, yeah. Yeah, that's true. That's true. Okay, thank you.
Take care.
See you.
Professor, just wanted to clarify. So exactly how are you using the Black-Scholes formula to value the company?
Use the Black-Scholes. You don't value the company. The conversion option, a convertible bond, is an option. It's a very small piece.
Yeah.
The whole process. So I'm not sure what you mean by how do you use a Black-Scholes. You have all of the option pricing inputs will be in the conversion option, right? There's an S, a K, an R. So you just plug the numbers. So the using of the Black-Scholes is the easiest part of this process because all the parameters will be given to you in the conversion option.
Right, but in terms of estimating the volatility, because Black-Scholes formula treats that as a given, but it's not actually for example, if a company is not.
It's the easiest of all inputs. Look up. There's a publicly traded company, right? Stock is traded.
Yeah, but oftentimes the price of an option doesn't match the actual underlying volatility. That's the discrepancy between implied and underlying volatility, right?
I think you're lost in the forest of options. This is that's not a problem with the Black-Scholes. It's a problem with how you compute variance. If you're asking, should I use an implied variance from options issued by the company, or should I use a historical variance? No, you can make your choice, but that's the least of your worries. That's a third decimal point problem.
Okay,
is there any model out there that doesn't require estimates that could be wrong? I mean, the Black-Scholes probably is the least exposed to mistakes on your inputs because it's the fewest outside estimates.
I see. Got it. Okay. Thank you, Professor.
So don't let the perfect be the enemy of the good.
True. Yeah, understood.
Take care. Talk to you later.